Please welcome the panel on Institutional Investors, Staying the Course or Catching the Wave, moderated by Chief Investment Officer of CalSTRS, Christopher Ailman.
Well, welcome to Wednesday, everybody, and thank you for coming to this session. I am going to ask you to put your hands together in a second because what's before you, I think, is pretty rare sadly, in the investment business, which is an all-woman panel of CIOs. And shout out at Milken Institute to Aaron, and Amanda who put this together because this is really awesome. So please put your hands together one more time. We also have an international panel. These ladies run funds, a variety of funds, not just as I do public pensions, but a bunch of different funds, different asset sizes around the world. So I'm going to ask each of them to introduce themselves, their fund, and their location. If you want to mention the size, go ahead. But I'm going to start with the CIO of the Year, announced by CIO Magazine in December. Elizabeth.
Thanks, Chris, and thank you, everybody, for being here, and thanks to Milken for having us. It's a rare occasion to be on the stage with not only four very talented women, but beautiful women, and very fun to be around. So I'm Liz Tulloch. I'm very honored to represent the plans at the Boeing Company. Our plans are $116 billion in total, with $46 billion in our defined benefit plan, and then another $70 billion plus in our defined contribution plan. Our team works out of Chicago, even though our company hub and headquarters is based in Virginia.
Hi, good morning. My name is Bei Seville, and I'm here representing Advance. We're a private, family-held business based in New York. And the family has been accumulating and growing a portfolio of assets across media, entertainment, technology, communications, and other growth areas. And I'm just very happy to be here to participate in this panel.
I'm Molly Murphy. I'm the Chief Investment Officer for the Orange County Retirement System. That's the Orange County in California, not Florida. So we're about 50 miles south of here. And we're a multi-employer plan administrator for about 24 total plans. 13 of them are currently open, and we're about $23 billion in AUM.
I'm Alison Hill. I'm from a little further afield, Brisbane, Australia. I represent QIC, which is a sovereign wealth fund in Australia, managing about 70 billion Australian dollars on behalf of the Queensland government and its various entities.
Hi, and I'm Amy Diamond. It's an honor to be here. Thank you, Chris. So I'm the Chief Investment Officer of University of Southern California, so I'm the hometown girl. We're about $8 billion.
USC.
Fight on.
I'll share my jokes later. I went to a UC school, so a little rivalry there. Hey, I want to remind everybody we do take, at the end of this panel, audience questions. So there's a QR code that they will put up on the screen. You can scan that with your phones. And the questions will come to me during the panel at the end, and I'll be able to ask those. And no Elon Musk kind of questions. Nothing about Mars, nothing about crash landing. So the name of our panel is Catching the Wave or Staying the Course. I have grilled Milken staff about what wave. So you get any variety of choice. The wave could be obviously private credit. A lot of us have run into that area. It could be AI. It could be ESG. Or staying the course. And Amy, we're going to start with you and go that way. Staying the course or catching a wave? You're putting in themes in your portfolio.
I'm going to say it's both. I would say that our course is to ride waves. So we believe that to make money over the long term, we need to bet in innovation and change. So we think about the market leadership in the market, usually it doesn't extend past a decade, and so there's always going to be new innovation in new areas that we want to invest in. We want to be early. So when I think about staying the course, it's planting the seeds in venture capital, and it's active management in the equity markets to sort of see what the next wave will be. So this AI thing seems to be legit.
There have been 1 million panels here. Alison?
I'm going to go with riding the wave. I think if you reflect back on the prior sort of investing environment, we've had, zero or low interest rates, we've had zero or low inflation, we've had, very stable, in general, geopolitical environment, and that has led to, I guess, an environment that allowed for globalization, and it also allowed for, I guess, a lot of, lower volatility in the markets. I think if you look forward, a lot of those criteria or factors have changed. We've got real interest rates for the first time in a long time. We've got inflation, which is proving a bit sticky in lots of parts of the world, and could create some volatility. So I think those opportunity set really brings forth, there's some certain alpha strategies which are more difficult in that environment, but I think they're now more present. So we're rotating the portfolio to be able to think about those kind of themes. We're thinking about what it means to be invested in illiquids, where previously I think, having a lot of leverage and leaning into liquidity premium made a lot of sense for our portfolio. But looking forward, if we're thinking there's more volatility, perhaps we're going to have a little bit more optionality and perhaps have a little bit less in the illiquid space and be able to move a little bit more freely to take advantages of opportunities as they present themselves. So it's not a complete out with the old by any stretch. We'll still have, core assets and core portfolios, but we are thinking about how do we shift forward for what is a new environment and try and find the best, risk-adjusted returns in trying to meet what we have as CPI plus targets.
It is really tough to be that balance between being flexible, not market timing, but being flexible in that, and then still hitting your long-term targets.
Yeah, absolutely.
Molly? You're in the surfing capital. You've got
We are.
You've got the wedge. That's what it's called.
The wedge.
in
We do
Newport
have the
Beach.
wedge. You have to come to Balboa Peninsula to go find the wedge. It's not cheese. So I would say what's interesting about this is sometimes the wave also shows you areas where the wave has moved and the water has receded. And so there's the big AI wave, but what has receded is institutional capital going into venture capital. So, one place where we're trying to look for ideas is where the white space has shown up in the economy or in just manager flows. So a lot of money has gone into safer fixed income assets. We're still trying to look for areas, say in asset-backed lending and other things where money has not been as plentiful, because we can get better terms, we can get more capacity sometimes. Same way with venture capital right now, so we're doing a little bit of that. But, why not take the easy lift all boats moment too and have, more conservative credit strategies now pay you more. That's an easy trade to do. So I think we're doing a little bit of catching the wave and waiting for the water to recede.
So for us, we're a long-term investor. And when we look at our portfolio, it's really, how can we satisfy our near-term obligations, at the same time really cultivate a portfolio of trusted partners where we can grow, not only achieve financial success, but also doing something that matters. So when we have that mindset, what we're looking at today, AI would be a great example. I like the description about what's the wave and what's actually giving in. For us, not only we're looking at from investing perspective in those trends, but also to the point of what's giving in. We're looking at how these trends are impacting our portfolio, what companies are actually potentially can take advantage, or companies may be impacted. But given it's such a long secular, it may, matter of fact, it could be a very long lasting trend. Any decisions we're making today might take a very long time to see the results. So we also want to make sure that we're patient when making those decisions, we're doing a lot of internal research. AI is the example, but there are other areas we're looking at as well.
So Elizabeth, are there waves in Chicago?
We have lots of waves in Chicago. Probably not in our plan, but on the lake. We're on Lake Michigan. But for us, I would say it's not a question of or. It's a question. It's more an answer of and. And so when you think about our portfolio and you take a step back and you look at our asset allocation, we have about half our assets in fixed income. And you may say, why is that? Well, right now the Boeing plan is frozen and closed, so there are no new accruals. And the number one goal that we have is to pay those monthly benefits. And so we want our assets to move in sync with that liability. We want to match it on duration. And by doing that, we're able to then hedge against and protect against interest rate moves that can wildly swing our liability. But then it also frees up the other half of the portfolio to then catch the waves. And so we invest across all the asset classes, including private equity, hedge funds, real estate, real assets, global equities. And then we can dip in to different areas that we find of interest and catch the themes like AI through our venture managers. So I think in total we do both, but we do it a little bit more at different periods in time.
You ladies are splitting it, kind of both. Everybody's catching the wave and staying at home, so pretty impressive. And it's interesting because we've got obviously family offices, endowment, a sovereign wealth fund, basically, public pension, and a corporate plan. Very different liabilities, different sizes, and different abilities to be nimble. One of the topics that I've been I talk to some global CIOs on a regular basis, and it's certainly the Maple 8 in Canada and then a lot of the US funds, has been geopolitical risk. We all learned that hard lesson with Russia, and now obviously it's not just, it is obviously the Middle East, but clearly China. How are you considering geopolitical risk? How do you deal with that in your plan? Allison, what's the perspective from down under?
Yeah, well, I think there's a couple of different ways of thinking about it. I mean, firstly, I talked about, I guess, that optionality before, and what you really want in any investment is a rule of law, and you want to make sure that if you need to, you can get out. And so I think sort of trying to plan well ahead if you think there might be scenarios or situations where either you think the risk is intolerable from an investment perspective, or your stakeholders say, we no longer want to be here for whatever reason it is, which is more political in nature. So we're very cautious for some areas, particularly China, when it comes to illiquid investments. Obviously, an illiquid investment, 5, 10, 15 years, it can take a very long time. So we have been a bit more cautious, I guess, in our investing in that space. But, as it pertains to, I guess, the broader portfolio, we try and just to really balance what we perceive as the risk versus the returns. So it's challenging. I mean, the world is getting much more bifurcated in its sort of, I guess, it's the blocks that are building from an economic perspective. So it does create more challenges from an investment perspective. So I think there's a number of different ways that you have to think about it within the portfolio. And then really, from our perspective, we're trying to predominantly make sure we minimise the risks, and where we do think there's opportunities, take advantage of those.
And Molly, you're at a county level. I'm at the state level. Certainly geopolitics shows up at the state. But do you feel that on your board in the county level?
So I think you're always cognizant of it being an undertone to everything you do, even if you're at a plan that doesn't get the same scrutiny as a state plan of course, your size. I would say what we've really focused on is pulling the rhetoric away from the country risk. So, this is an election year in the US. Both sides, both candidates are going to have a common theme on China, most likely. They're going to have to come out strong. But when you look at the demographics, the economics of what's happening in China, their markets have underperformed. We were underweight China for the last 2 years, just on that alone. So we're trying to look at currency risk and the real country risk we're taking on, and hopefully the rhetoric will stay in the noise zone, but every day's a new, fresh opportunity to be wrong on that. So, we'll see how it goes as we head into the frenzy of the last gasp of the US election cycle. It could get a little bit more uncomfortable. But my board has been very supportive of really understanding the risks of our portfolio, and not all of the pundits.
Are you at a family office, are you shielded from that pressure, or do you have to factor it in?
Yeah, because we're private, I think even though we don't have a certain obligation to disclose, but clearly there are some regulations these days about private funds disclosure that we're not totally can avoid it. But I would say as an investor, clearly you look at this, first of all, diversification, but that may not be enough. What we're looking at is from both risk and opportunity side. Just like AI, there's something advanced, something will retreat. Same as geopolitics. When you really look into that, it's a broader issue, just like wealth gap here. So when we look at this, what are the risks? Risk can be diversified or entirely not to engage. And what are the opportunities? There has been a lot of supply chain redesign, onshoring, and the commodities. All of the secure people and country are looking for securities in critical material, critical technology. Some of this take a very long time and the type of investment, and we are looking at where the value actually will be resides and created. How can we position ourselves to do something that matters?
Good, excellent. Elizabeth?
So at Boeing, we believe that geopolitical risks are one of the risks that we have to manage and monitor. And it's our job as a fiduciary for the plan assets to make sure that we're considering all the risks around us. I would tell you that we actively seek out the conversations on geopolitical risk and just tensions in general. And I think it heightens the level of sensitivity in our team to what's going on in the world around us, but it also informs the decision making. I would tell you that we do have country-specific conversations, but we try to approach it from a high level as well as build our portfolio from the bottom up. And as someone said, sometimes these situations create opportunities. At the end of the day, that input then goes into our risk system, and then we're able to better assess the overall exposure we have in the portfolio and how much of a risk it truly is. We'll talk to our committee about certain topics that could include geopolitical tensions, but we always try to make sure what we're doing is making decisions for the betterment of our participants. And sometimes these situations create great opportunities for investment for them.
Elizabeth, you also run a huge 401k.
Yep.
Do you feel pressure on changing the options because of geopolitical risks, or do you hear that from the employees?
We don't hear it from our employees, and so when you take a step back and you think about the Boeing company, we service countries around the world, airlines around the world, and so we try not to show any differentiation between countries. But I think our employees are pretty savvy. When you often hear people say, the rocket scientists in the room, we actually have them, and we get questions from them. And so the way we designed our menu was to be flexible, to give people optionality. They can either do it for themselves, or we can do it for them through our target date funds, but we also give them active and passive options. And then at the end of the day, they can make the choices they want. We haven't really gotten, it's an interesting question, Chris, we haven't really gotten any questions about specific countries, I think in part because we're a global business.
Yeah, that's interesting. You do make rockets, I forget that.
Yes.
Amy, USC's been just quiet. Nothing's been going on this last 2 weeks. So how do you deal with geopolitical risk?
Well, we'll talk about what we have in the endowment. So geopolitical risk is something that's not new. So macro or geopolitical risk can swamp fundamentals for very long periods of time. So we think about the early 2000s where we all made a lot of money in emerging markets and investments in China. And we also at that time chose to invest in venture capital as one of the ways to participate in the growth in China, in the economy there, in the technology sector. And we're still holding a lot of those investments today. So when we look at our exposure to China, half of it, if not more at this point, is in private investments where we have less flexibility. But when we think about the public side of it, it's really the competition for capital. And why would we look to invest outside the US? We would have to get some incremental return or believe that there is some diversification benefits for it. And we're finding opportunities in emerging markets, some of them just are not in China. So it's really becomes the conversation which a lot of you had talked about, which is compare opportunities rather than just making a specific decision to put an X through a country.
And China being such a huge part of the EM, though, has really dominated that market.
Right.
I know at this conference we sometimes have talked about sub-Saharan Africa. There's been a pitch for other parts of the emerging markets. At one point, Brazil, obviously South Korea, Mexico being dominant. And I think it's interesting, almost all of us were at the Global Capital Markets Advisory Committee yesterday morning and heard a plea from Argentina, which I think historically for many of us would have been uninvestable. But I'm going to go back and tell the team it's worth looking at as an emerging market for the first time. It'd be interesting. Let me shift gears to private markets. All of you have very different portfolios because of the liabilities. So, I'm curious your view. Certainly the private equity market just has been frozen. The real estate market is frozen because of the office uncertainty. Obviously, you probably all have apartment and warehouse investments, which have done quite well. But share with the audience, think for a minute about roughly what percentage of your assets are just, we'll call it privates. Think of real estate, private equity. You can throw in infrastructure if you want. And then share your view. Do you think those markets will unthaw if we come back to Milken 2025? Are we going to be back to normal, or are we still going to see a frozen, say, private equity market? Molly, how about you?
Orange County is a little bit unique in that we have been cash flow positive for many, many years. We just actually, about 18 months ago, went cash flow negative. So we have actually been building into our private exposures with the mindset that we don't need distributions yet. So we're a little bit different. We entered this phase with such a decided J curve because we've been increasing private equity by target for so long that we were underwater. This just makes us a little bit more. So we're a little bit different than the rest of the U.S. pension community that has to make 2 to 5% distributions per year. So I'm probably not the best one to answer that, but I will tell you I have more concern about the lack of movement and frozen markets in our non-core real estate holdings. That's going to take 5+ years to really...
What baskets, what would you describe as non-core real estate?
What would I describe as non-core real estate?
Is that senior housing, public storage?
Yes.
Hospitality?
Yes. I mean, obviously the one that we're almost concerned about is the office and how that's going to reinvent itself. We did not have a huge portfolio of office, so we're in a little bit better condition.
I can give you one. If you really want.
I was going to say you might want to comment on that. You're going to give that problem to someone else in a few days. But, we still are pretty fine with that. We were only at about 10% office, but we have to look at that and say, that still has some zeros and commas, and it's going to be frozen for quite a period of time. We do have medical office and multifamily and all the different food groups. Those are a lot healthier. In private equity, we're already starting to see the market thaw a little bit. Not enough, absolutely. But our position is so much different than the rest of the pension community. We're not reliant there for distributions.
Why?
So for us, primarily we're private. We're privately held, and the business has been around for just 101 years. I would say in our financial portfolio, that's investable portfolio, private is a key component where we do see the illiquid premium. And in the market today, even though the market has been frozen for some time, and with the rate staying at this level driven by the labor market, it's probably going to last for some time, even though the IPOs start to see the activities. But if you look back in history, this is nothing unique. We have seen this played many times before. And this time we're also seeing
because the wealth created across the globe, you see other investors actually coming in. So I do think the private market today is much more diversified from the new people coming in that have a different cost of capital and different holding horizon. So there will be opportunities for solutions provided to create opportunity for different private assets to be restructured, combined, consolidated, and for different type of cost of capital holders to hold. So I'm not that pessimistic. There, I think the number I heard this morning is 1.5 trillion dry powder. It's probably even higher than that if you combine all of the sovereign wealth and the private entities around the globe that potentially can participate. And depends on the quality of the assets. I do think there's still going to be good opportunities for private investors to capture.
Elizabeth, your plan, being a closed plan, do you still have a good allocation to privates, or are you really fixed in liquids?
So it's a really good question. We still have just over 25% of our portfolio in privates, and I think that will continue for some time as we're only 93% funded. So we have 93 cents of assets for every dollar of liability that we have in our portfolio. I will tell you that we invest across all of the privates. Private equity certainly is probably one of the oldest asset classes in our portfolio, as is real estate. I like to think that I am an optimistic realist in that there are always opportunities no matter what market environment you find yourself in. I think today, though, we have a couple of pain points. The core real estate funds are not distributing any capital despite sitting in the queues with probably all of you in the core real estate queues, and that's been a little bit frustrating, and until that resolves itself, I don't see us being able to redeploy as easily as we have in the past. And it's actually been something that's frustrated me. I'm like, every time we rely on the core real estate funds to give us those distributions or give us liquidity, it's never there. Think GFC, it was the same thing. So we're kind of rethinking that strategy of investing in the funds at the levels we have. And then the other pain point that I see today in today's market is really private equity. I can remember maybe 2 years ago, I think Amy's in the same fund, one of our managers on a call, we built a venture program in the 2000s, and one of the managers was touting over $25 billion of public securities. And it really frustrated me because I thought the venture process is done. You've got public securities, they belong to our participants. You should be sending them back to us to redeploy and recommit. And it's not happening. And it hadn't happened over the last couple of years, and we saw our distributions dry up. I'll tell you, we are starting to see that come back in a modest fashion. I think the message is getting out there. Managers want to fundraise, and they're out of capital. And when they come to us, we're saying, where's all our capital that we've already given you? When you can give us some of that back, we'll recommit. And so you see that fundraising cycle slowing down and managers really trying to address their portfolios. And I think that's been the reason why we've seen continuation vehicles in private equity. We've seen the secondaries market pick up, not only in private equity, but even in real estate and real assets, especially in energy. And so I do think there are opportunities. You just have to be clever about how you approach them. And how you approach them today might be very different in how you approached them even 2 years ago. For example, in private equity, when you may have made only just investments in funds directly, now you can actually invest in a secondary fund and shorten that J curve. So you have to be a little bit more creative today, but I always think there's opportunities to be had if you look hard enough.
Amy, I mean, endowments usually love private markets.
Yeah.
Are you increasing your pacing, or how do you deal with this market?
Yeah, I mean, so Liz and I sort of grew up together in private equity. We were children in Chicago together doing it, and we have a lot of battle scars. And some of them, a lot of it was around liquidity planning when you're making commitments to privates. And so I always have this belief that have a stress case and a severe stress case. And if you are comfortable with how illiquid you're going to get in those scenarios, and that is how every asset class interrelates with each other, but also how many gifts we would get into the endowment at that time, what the draws on the endowment would be for spending and payout. So really be intellectually honest about how bad things can get, and are you okay with that? It's not going to feel good, but can you manage it? That's the baseline. So we learned a lot of hard lessons at the universities we were with then, and that helped us be a little bit better prepared for this, what we're having now and feeling on the liquidity front. But the other thing, the other side of it is if you're partnered with the right managers, I don't care if the company's private or public or, I want to have I want returns that compound. And I'm very excited when I look through our portfolio at some of the largest positions in the private portfolio. They're damn good companies. And they're growing and they're cash flowing. There's no liquidity. The marks, I don't know if the marks are right or not, but we're comfortable owning them without, at this point, still being private. So there's the other lesson that we learned too, which is you don't want to miss a vintage. And some of it's going to come from the obvious, this is all obvious, everything I say is obvious, but the unfunded commitments that we have are going to get drawn over the coming years. Great, we're going to get new vintages, new prices, et cetera. But it's also committing to new funds because we know the alignment with managers. If they're going to have a pool of capital today, that's probably going to be a great return potentially going forward. And so we want to stay in the markets. Real estate's a different thing. Real estate we also spend a lot of time I've spent a lot of time in my past in real estate. It doesn't protect the way we think it's going to. So that competition for private dollars, there are going to be great opportunities in real estate because everybody's hating. We're all agreeing that there's a lot of repricing that has to happen there, but it's going to be incredibly selective, and it's got to compete versus illiquid dollars and planting seeds in venture capital or some interesting growth capital or private equity or in infrastructure.
Allison, you and I, we were at a CIO conference in Melbourne. There was kind of mixed optimism about privates. How are you dealing with it as from a sovereign wealth fund perspective?
Yeah, from our perspective, I mean, a lot of similar themes to the other panelists, really. But I think from a couple of perspectives, we have put in place a framework about a cost of capital kind of concept. So we have a total portfolio approach. Really, we're looking for the next best diversifying opportunity in the portfolio to the extent that we can achieve that. And so when we're looking at a private opportunity, there is a cost of capital in relation to that illiquidity, I guess optionality that you lose when you're locking money away. So we need to think about, what are our forward-looking expectations of returns, and that I think is different in an environment where leverage is harder to come by and is also more expensive. It's competing on, I guess, a slightly different playing field. So we are sort of very much focused on that. Our portfolio has around about 40% to private markets across real estate, private debt, private equity, infrastructure, and some insurance-linked securities. We do try and break that into sort of medium-term and longer-term liquids to try and sort of give it a little bit of nuance. But, really, I think there will be opportunities there, but it comes down to valuations. Markets will reopen when people feel that the value is there. At this stage, nothing's really moving because people are sort of concerned that really valuations haven't hit that market. So that's sort of really, you're starting to see it move a little bit more in infrastructure, I think, but real estate's still got a way to go. In private equity, we need the IPO market to come back. There's a few signals that perhaps there is some, there's been a few IPOs recently. But I think there is just a degree of caution for the reason that, when you want the money, it hasn't been able to get there. Some of the returns have been a bit softer than perhaps you would have liked from these asset classes. And then you look beyond that to the other opportunity sets that are out there. I think it's just a slightly different horizontal outlook.
My next question is about private credit, and I want to open up to any of you. Private credit has been listed in the news, and I guess we probably have Bloomberg and Pension and Investments and Reuters and Nikkei and all these publications here in the audience live streaming you out. So with that in mind, though, private credit, are you slowing down? Are you investing in that area? Are you increasing, slowing down? What's your outlook for that? And I know I've talked to a lot of global CIOs who, for the first time, they look at the narrow spread in investment grade and even in high yield liquid debt, and they're pulling that out of their Bloomberg Ag, and they're plunking in private debt as an interesting option within their fixed income portfolio. Open question to anybody, how are you thinking about it?
So I'll start. Orange County was very early to this trade. And I'm from the fixed income universe. I did 15 years in fixed income asset management and trading before I flipped to the allocator side, so I'm really comfortable in that space. You know, it started out with mezz funds pre-GFC and CDOs and CLO product, and of course they all blew up. And then it reinvented itself post-GFC. And Orange County, being what I would call an ultra-conservative pension plan at that time, we're more peer-like now, went in to private credit with a lot of enthusiasm starting in around 2010, 2011. I like to say we bought everything that came through the door, because when I got there, we had over 6% of AUM, even though we'd cash flowed off already for 6 years by the time I got there. We had 13 different just direct lending strategies at that time. We actually then thought about that was private credit 1.0 for us. So private credit 2.0 was picking winners and having high conviction, larger portfolio relationships. Private credit 3.0 for us now, and that's when we were trimming. We got down to about 3% of total AUM. We're back up to about 4 because we actually see that new entrants are starting to try to diversify or become distinct from that flow business of unsecured corporate lending. There are no barriers to entry to that business model. So we're trying to now look at where are moats being formed around business models. We're seeing that in the asset-backed lending space, specialty lending. So I would say we're kind of on private credit 3.0.
Anybody else?
I mean, we've been in, like Molly's experience, I think private credit is just the term of this time period. But this really dates back to pre-GFC, and it goes back to a world where you weren't so bucketed. So private equity was really the catch-all for all the interesting things that we saw in our portfolio. So we too also had mezz funds, we had distressed funds. And then GFC happened, post-GFC we saw the bank loan funds, and those were kind of interesting, but they weren't really hitting the private equity targets, and they didn't actually, most of them didn't work out very well. And so we started to segregate the world a little bit more, and that was a time period where we started to see some different special situation funds coming out. And so we started building what we call RSFI, return-seeking fixed income at that time, and it was just a couple of percent. But a couple percent on a $46 billion is actually a lot of money. So we just started finding really interesting ideas in the portfolio and things that slipped through the cracks that didn't formally fit in private equity, didn't really fit in traditional asset classes. And we started to tuck those away into an RSFI portfolio. And today we've built this portfolio out to cover both public and privates. And what it really does is it gives us the flexibility to look at things that fall through the cracks of those formal traditional structures. The other thing that we've been doing is looking at our liability hedging assets portfolio, which has traditionally been long duration fixed income, and starting to think about whether there's an opportunistic piece to this. Not only does it capture some of the features of private credit today, but it also then matches our liability and enhances our return a little bit so we can beat our benchmarks. So this isn't something new to us. It's been a journey. Like Molly said, you have a 1.0 version, a 2.0 version. We're probably on version 5.0 by now. And I think it'll continue to evolve. There's obviously really interesting opportunities there, and I'm sure you're tired of hearing the phrase private credit from this conference. But I do think it gives us a new opportunity to explore areas that maybe weren't previously open to us because of the way the banks are changing their strategies going forward.
Yeah, we've also renamed our fixed income groups. We used to use the traditional fixed income or credit monikers. Now we just call it income strategies. We've realized we don't need to be dependent on the security structure that produces the income as a label. I loathe labels to begin with, but now this can now encompass preferred equity strategies or music royalties or other royalty strategies or any non-traditional product that can produce 50% of its return attribution from income. So.
Amy?
So I have a little different view about private credit. Well, I used to always say that I'm allergic to par loans, because if you don't want to buy a par loan, you can buy it cheaper in a year or two. So we have really not had credit in the endowment. We're equity investors, and then the part that's not equity, we're trying to find areas that we can really find inefficient markets, real diversification in a very different way. That being said, given what's happened with this fast rise in rates, there are some interesting sort of structured credit or pockets in the market that one would call private credit, but it's not the funding LBOs. The issue I have with that is when there's so much capital going in, it becomes a competition for price and low terms. And so it leads to the potential for a bad outcome, or you're not getting paid for the risk you're taking. And so it's interesting to watch all of this, the rise in private credit, and how many panels we're here that we're discussing it, and all the conversations and books that we all get about offering these opportunities. And we want to go back to the fundamentals of why are we owning something, and are we getting paid for the risk we're taking? And so that's leading us away from doing very much in sort of a generic sort of or plain vanilla private credit.
Yeah, I can add just maybe from family office perspective, but before family office, I was in the ENF world as well. I think one of the change for me is tax, the consideration for tax. Obviously, if the payout is income, there's a penalty for that. But with that said, I think in the end, no matter what, taxable or tax exempt, the investors really care about what kind of risk we're taking, for what horizon, and what's the payout. If that's justified, then that's risk well paid. And also whether it's diversified. For us, because most of our portfolio will be taxable, tax is a consideration. So what we have been doing, I think a lot of things that have been discussed here, is really long-term contractual backed cash flow. And for taxable portfolios, ideally, if they can come through as capital gains instead of income, that would be preferred. And with some level of optionality, either through continued growth or buying at a better price, or the industry is experiencing a tailwind. So a lot of things that potentially create a optionality combined with this income stream that's more like a capital capital gains. That's our approach so far. And maybe just one more comment as I was listening to everyone's comments. It reminded me of hedge funds days, yes. Right? It's it's private credit a word catch-all. It's a area where talent goes, where you can use more innovative structures to provide solutions. And that's what the hedge fund used to do. And I think actually a lot of private credit also has a healthy exposure in the hedge fund space already. And some of the hedge funds are launching private credit as well.
You ladies have attracted a heck of a lot of questions. So I'm going to dive into some of these and make it more of a rapid fire round. First one I'll jump on here is, where'd it go? There we go. What's your view on investing in secondaries as well as LP-led transactions? Would you do co-investments with another LP like one of the Canadians?
So we're not co-investors. We just don't think, we think there's a very specialized skill set that it requires to be good at co-investing. I've done it in a prior life. I just don't have the resources to do it in our structure today. But I do think the secondary market is actually pretty attractive. You start to see situations where there's things that have to happen, funds need to wrap up. I think pricing is a little bit tight right now, but I do think you can be exposed through secondary funds and really benefit from some of the pressures that private equity is feeling today.
Anybody else?
We are starting secondaries, buying and selling. We'll call it a project more than an action right now, but by the end of the year, we'll probably be ramped up. We also have an active co-investment program for private equity only at this point in time. We've done a little bit in credit, but not enough to call it a thing yet. So where we can do it with our team, I think the resources are the challenge.
Amy, you like buying stuff below par. Do you like buying secondary?
It's tough. I would like to think we could do it, but it's tough because at the end of the day, we're underwriting managers. So if it's a secondary in a fund that we're already in, we feel really good about the manager and it's at a discounted price, I'd love it. But if it's having to go and underwrite a new manager, it's difficult. So,
Allison, you've got a ton of pension plans and schemes, pension schemes in Melbourne. Are you seeing a secondary market just within Australia, or?
Not a lot, to be honest. I mean, I think there's sort of some concerns about, I guess, the various sort of secondaries and continuation funds and other things you're seeing in the private equity space, and what are the motivations behind that? Obviously, there's going to be some which are going to be really good opportunities, and then there's others that sort of does it create issues with alignment and why those things are sort of occurring. Certainly in the Australian space, co-investments are very desired. I'm not part of the pension universe specifically, but work closely alongside many of my peers there, and they've got sizable teams. They value the ability to be able to work alongside other LPs and the GPs in accessing more direct to give themselves governance. It helps from a fee perspective and just also scale as well. So very strongly desired across really the entire private market space. We're a little bit more like yourself, Liz, in that we're not really set up from a team perspective to co-invest. So we do have sleeves with managers where we'll ask them to facilitate that for us, but it's done largely on a non-discretionary basis. So.
Another fun question, and Molly, I'm going to start with you because I know it's your favorite subject. Do you use a consultant, and are they telling you to avoid or go into any one particular place? And a shout out, Molly and I serve on the Kroner Financial Research Center at UC San Diego, and there's a paper coming out soon that evaluates consultants and whether they add value or not. So stay tuned for that. Molly.
Well, I already know what the paper says, so this is a loaded question. The U.S. pension community uses a lot of consultants. I think everyone uses them in a different way. So I think the concept is great if you can find someone that really supports where your pension needs to go and it adds value. And that value can be extension of staff. It can be, like being a human shield sometimes for some of these conversations. It can be whatever you want it to be. Orange County happens to have 3. We have 1 generalist and then 2 asset class or sector specialists. I think we have a great relationship with consultants because we've chosen ones that act and think the same way our organization does. But there are a lot of dysfunctional relationships around.
What a polite way to put it, dysfunctional relationships. Anybody else use a consultant?
So we do use consultants, but I would tell you that our investment committee has no clue that they exist. What they tell us is you can use whoever you want, but at the end of the day, it's you and your team that need to make the decision and convey that decision to us. So they never come to our investment committee meeting. I'm not even sure they know they exist. And we've had a storied past. We've had a great consultant. We worked with them for many years. But during COVID, it seemed like it changed. They've gone through some changes as well. And so what I began to hear from our team was that they wanted thought leadership and they wanted to be challenged. We didn't want to go to our consultant, and this is our general consultant, and say, we're thinking about this, and they say, great idea. And then we come with another idea. We're thinking about this, great idea. So we didn't want somebody to tell us that we were great. Everybody else tells us that. All the managers, when they're selling, tell us how great we are. So we don't need the consultant to tell us we're great. We wanted somebody who was going to come in and challenge us. And not only challenge us, but also take us to a higher level of thinking. So we did a consultant search, and we have just engaged with a new consultant. Having said that, I don't think any consultant can truly meet the needs of a large plan or a large program, and so we complement that when we need it. So we're also clients with it's more of a private markets database that has, you would all know them, they're Alborn. So we use Alborn strategically. It helps us kind of sort through the noise. When we do get fund inquiries, we can quickly read their notes and understand who the manager is and whether they're a fit for our program. And it's helped us just become more efficient. So overall, we'll get the resources we need, but they ultimately never go to our investment committee in their form. They would like to. They would love to have that conversation. But our team presents, our team makes the decision, and they really drive the process. But we're also looking for that challenge, and so anytime the consultant can challenge us, we'll take it on.
Anybody else?
We also use Ailman. I find that the engagement can be passive and active. They have a pool of data. I mean, not just them. There are a lot of database exist out there. But today, with the AI, I find that there are certain experience you can draw from people who are dealing with data every day and how they are approaching this and the system they have developed. I find that those relationships very useful.
We certainly use consultants, but we have a generalist retainer consultant, and for us it's actually fantastic because they know us well enough that they can actually challenge us and debate us, and I can go and say, do you think this is a good idea? And they'll say yes, no, and vice versa. They'll come to us with ideas, but we also use them for different consultants for specialist assignments, which really helps us with screening universes, really getting across the breadth, which it's hard to do with a team of our size. So they're very much a helpful tool, and we try and work in partnership.
We use a big pool of consultants, which I call a smack of consultants, because that's what you call a big pod of jellyfish. I will not go into detail of why I picked jellyfish. Molly's got that one. Okay, hey, we have a question about women. So as women, do you feel pressure to hire female money managers? And I'll expand on that. Are you looking for female-only managers? What's your outlook? Because I know we get a lot of pressure on diversity. And to me, I love the phrase I picked up in Australia, cognitive diversity. But, as women, how do you feel about that? Are you feeling that pressure?
I think from my perspective, the cognitive diversity is incredibly important. That comes from gender, it comes from age, it comes from where you went to school.
Thank you for raising age. I really, as the old person on the panel, I appreciate that.
But it comes different points of view, different educated points of view that have come from different backgrounds leads to a better decision. And you want challenges to your decisions because what we're doing is not black and white. There is no exactly 1 + 1. It is a range of qualitative and quantitative considerations that you need to come together and debate how is this going to work and make sure we can get the best portfolio. So absolutely do I look for diversity in the managers that we hire, very much so, because I think it leads to better investment decision making.
Anything else?
I think it starts with your team. My team is extremely diverse. This may be something that's only replicable in certain areas, California being one of them, because we can recruit talent globally, but 60+% of my team are female. They're going to network differently than a white male counterpart. Neither one of them is good or bad, and the only thing that's going to go in the portfolio is something that raises the bar from a risk-adjusted return perspective. So if you start loading your portfolio by checking boxes, you will get what you pay for, so to speak. So, but you will have a different network if the people sourcing your team have cognitive diversity, ethnic, religious,
age.
Language is another one. I'm not going with age because I'm up there too. But 2/3 of our team are non-white. 60% of our team, English as a second language. We speak 12 languages.
Wow.
So if you are already built for that, your portfolio will naturally, organically start to reflect that ecosystem that you farm from. So I don't think there's any pressure to load the portfolio with things that aren't return-based.
For us, we try to lead by example. So similar to Molly, our team is just over half women. And this is an effort that's taken probably 15 years for us to get here. So we're very proud of that fact. I don't like to use the word cognitive diversity because when you say that to a manager, they tell me, well, we all went to different schools. And then I'm looking around the table and it's all white male. And I'm like, that's not exactly what we're trying to get at. Ultimately, for us, we're subject to ERISA. We always have to focus on what's best for our plan participants as their fiduciary. But if it's a level playing field, we always make sure that it's a level playing field by having different groups that represent diversity, by asking the questions of our managers, what are you doing to improve diversity? I also have to say we got the Senator Menendez love letter, as I call it, who asked us to tell them about our diversity assets, and we were very proud to say we had $5 billion in diversity assets. But at the end of the day, that came from bottoms-up analysis, finding the best teams to execute on the strategy we were hiring for, and then delivering returns. All things being equal, I'd love to hire more women in the portfolio. I'd love to hire more diversity in the portfolio, and we do our best, but sometimes it's hard for probably a longer conversation than we have time for.
Yeah, I agree with what everyone here has said. We're incredibly excited about the increasing diversity that's happening in our portfolio because the conversations that all of you are having, people in this room are having with our existing managers to just, we want better outcomes and we want more diverse views around the table. So that's great. But where we have found that we've even had additional success bringing diversity in our portfolio has been the fact that we can do first-time funds. And so a lot of times you're not going to find a woman or a diverse manager that has several funds under their belt. So we're able to take that risk and do first-time funds. And it's really exciting, and it's something we're incredibly proud of just to continue to do.
You know, we should note, I mean, it's very rare to have 5 women CIOs on a stage. And I think it's because of the efforts. We failed to mention that Chris also got a great award in December. He was recognized for his leadership in the industry. And one of the things he talked about was making sure that the industry reflects the normal the average population, the diversity of the population. And so the 5 of us would never be on this stage if it weren't for trailblazers like Chris, for putting in the effort, for using his voice to affect change. And so we have a lot to thank you for, Chris, as you go on to the next chapter of your life.
Thank you.
Thank you so much for your voice, for using it for all of us to be here. And it's up to us now to pay it forward to the other women in this industry. I think that there's a lot of great talent coming through. Not only women, but just diversity, making sure that you don't have to point out that this is rare to have 5 women on the stage. It's rare to have diversity. It should just be the way it should be, right?
Amen. Amen
But
to that.
thank you, Chris, for everything you've done.
Thank you. That's very kind. Other points of view?
Diversity is something we support, and both from an investment perspective and from to the our idea of cultivate partnership and do things that matter. A lot of times is to give someone an opportunity, and that's really what everyone needs. And I would say for us I think the challenge has been to have the will, but the idea of finding someone that can generate and have that idea. I think as this work more and more entrenched in the industry, we'll see more. There are certain sectors already seeing great results. In the healthcare sector in particular, we have seen great results.
Okay, 3 minutes left. Rapid fire, a quick just answer to the question. I have 3 on here about emerging markets. One specifically, do you like in India? So bullish or bearish on India, and then name a second emerging market you think would be interesting in the next year. Take a breath, think.
I'm bullish India. I think China is going to be really interesting given the valuations. I think you just have to hold your breath and hang on tight.
After hearing everything from Argentina, I'm very intrigued by what's happening there. I think it's a long, I know it needs a short answer, but I'll be quick. I think a lot of emerging market issue has been the instability of political system. Something can turn 180 degrees so quickly. So that's something we need to be aware. So align your investment horizon with that mindset. Related to India, we're still learning. Clearly, there are a lot of wonderful trends going there, but the valuation also reflect that.
Molly?
I'm hesitantly bullish on India, only because I've done 2 round trips of disappointment. So if you're in the business long enough, every 10 years it's the next greatest thing until it's not. So
I feel that way on Latin America. Like I've gotten, it's been like round trips.
You know, I was not paying attention to Argentina other than salacious stories of, politics. But after I heard what we heard at yesterday's breakfast, I am intrigued, I have to say.
Allison?
I like the term hesitantly bullish on India. I mean, it's a huge, huge country in terms of population, democratic country. They're doing a lot to reform in terms of regulation. So I think there's interesting opportunities there. Broadly, in terms of other areas to think about, I think sort of Southeast Asia, so things like Malaysia, Indonesia, Vietnam. I think there's a lot of benefits that sort of, I guess, this sort of nearshoring, friendshoring, I guess what could happen in terms of we're getting some of those facilities moved away from China and into other opportunities where there's, abundant and low-cost labour, so that is some really interesting opportunities developing there.
My team members are going to laugh. So India, I'm always negative on India, but we've still maintained our position, and I'm glad we do. So we have different views on our team. And then for opportunities, we recently funded a very concentrated niche manager in Africa. So I view it as a private equity. It's public equity, but I view it as private equity that we're going to do it. We're going to be in for the long term, but talk about unloved.
Excellent, excellent. I want you to please put your hands together one more time for this panel. And not just because it's 5 women. I'm so happy that it is. I'm proud, and I hope that continues. But 5 awesome CIOs who I greatly respect. Good luck this year. Hit it out of the park. Thank you.
Thank you.
Thank you.